Hi, welcome to Control and Compound with Darren Mitchell. I'm your host, Darren Mitchell, and joining me today is Christina Wyatt, wealth coach at Control and Compound Financial. Christina, how are you today?
Hey Darren, I'm doing great. Thanks so much for having me today.
Thanks for being here. So, today we're going to talk about mortgage insurance versus term insurance and how that applies to the infinite banking strategy. And, Christina, you have a real world example actually today that you can share with us. What were you doing earlier today?
Yeah, so earlier today I was sitting down with my lawyer signing some documents on closing on a property. And as we're going through those documents, there must have been about, 6, 7 pages, all on the mortgage insurance. So the lender's insurance that they wanted to offer me to put on that property. So myself, I just kind of breezed through because I knew that I had my own personal insurance. But for a lot of people sitting down, signing off on these documents, they're looking at it and they're thinking, okay, so which one am I? I'm going to take it. I've got to take it, right? Well, first off, you don't have to take it. That's one thing a lot of people don't realize is that you can have your own personal coverage. You can say no to that coverage. It's not required for you to get that lending. So today we want to talk about a lot about the differences between the lender or the mortgage protection and having your own personal, why the personal is so much better at the end of the day. The main and key differences there.
Yeah. Okay. Great. So let's just right off the bat, who benefits in the event of death? And again, we'll talk about death, disability, and critical illness. Let's stick with death now. Who benefits in the event of death in the two mortgage insurance versus term insurance?
Well, if you think about it, the bank is the owner of this insurance policy. The bank is the beneficiary in this insurance policy. So I think that kind of says it for itself that the bank, the bank owns, the bank wins from this policy. They're the one that is protected at the end of the day when we put these policies in place.
That's on the mortgage insurance. So
Yes.
so the bank's protected. And what about the term insurance?
So with the term insurance, you're the owner, your family or the named beneficiary that you want to put down there, they're going to receive the death benefit. You're going to own the policy, make the calls on the policy. So at the end of the day, it's you and your family that's protected when you purchase your own policy.
Okay. So now let's get into what um what amount gets paid out. So what amount gets paid out in a mortgage insurance scenario versus a term insurance? What's the difference on the actual amount at death?
So when you purchase a policy for mortgage insurance through your lender, they are going to, when you purchase it, it's going to be on the amount that you borrow. So let's just say that you have a $500,000 mortgage. So you're going to purchase a policy for $500,000 that day. You're going to pay the price for $500,000, and then as you pay down that mortgage, that death benefit's also going to decrease because remember they're only paying off the mortgage for you. They're not paying out a death benefit. So that means in 5 years time or down the road when you only have 250,000 left owing on that policy, or left owing on that mortgage, sorry, they're just going to pay out that amount for you. So you've been paying 500,000 of coverage this entire time, and what you're going to get paid out on is 250,000, which isn't great, right?
Wow. So in the term insurance, you get 500,000 payout, and the mortgage you'd get whatever the outstanding mortgage is, 250 in your example. Now, what if you want to switch mortgage providers? What if, okay, I'm at XYZ mortgage provider, but I can get a much better rate. What's the differences on switching and trying to find lower rates?
So with your mortgage insurance, when you leave that mortgage, you lose that coverage, right? It's gone. So if you want to switch, you have to switch to that whole new lender. You have to switch to a new policy, and you have to answer those questions that they put up there and make sure that you're still insurable. So when you switch providers, you're essentially switching your insurance and you're starting all over again. Brand new policy. Anytime that you want to go shop for a new rate or you want to, change your lenders. With your personal owned policy, you're going to be able to you keep it. You just have it the whole time. So as long as you've got it locked in, it's yours. You can change lenders as many times over as you want. You can change rates. It's not going to change that policy because it's owned by you. You make the calls on it.
Right. So you're basically risking that you're going to be insurable if you want to switch mortgages to a different provider if you have mortgage insurance because you can't go to that better rate or can't go to that better terms if you can't qualify for the insurance at that point. So again, huge differences. What other differences should we be talking about today?
Yeah, so you mentioned insurability. Again, that insurability piece is huge. When you go and you go to apply for a personal policy, you're going to fill in a life insurance application, you're going to get underwritten is what we call it, where they look at all your medical information and they decide, you're approved or you're declined. When you get approved on that application, you're approved. It's done. It's set for life, right? When you go and you complete a bank insurance app, when you're doing a bank application like I did this morning, there's a couple pieces of paper, and I sign off on it and I get it. So those couple pieces of paper are what's putting it in place. Darren, why don't you kind of go in a little bit more on those couple pieces of paper, because I know you've got a story that kind of goes well with this.
Yeah, so I get a real problem with mortgage insurance because I've seen over and over again how it doesn't pay. So mortgage insurance is called underwritten at time of claim. So underwritten at time of claim, what does that mean? It means they actually look at your medical questions at time of death or time of disability or critical illness. So what happens is you go to the bank, you fill out those pages of questions you declined today, Christina, and you go, yep, 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 and they go, okay, great, you've got mortgage insurance. They're going to take that file, they're going to put it in their filing cabinet, and they're going to sit there, and then down the road, if something happens, let's say 5 years, that person passes away, the bank is going to say, okay, well, let's decide if we need to pay this claim. And they're going to go take the file, they're going to go through it, they're going to go to your doctor, ask your doctor some questions, and they're going to try to find a reason why not to pay the claim, or not necessarily try to find a reason, but often they find a reason not to pay the claim. So that's underwritten at time of claim. With an insurance company, with term insurance, with a licensed advisor, you're going to get term insurance underwritten at time of issue. In other words, when they issue the contract, you're going to be approved at time of issue. So in other words, they're going to ask some medical questions and they're going to say yes, no, or rating. And if they say yes, you're approved, when you die in 5 years, they're not going to go back and dig through the file and try to go through to see if they're going to pay the claim. You were already approved. And again, the people that think they're covered for mortgage insurance, that wouldn't actually get paid is a much higher than people talk. And we see all kinds of stories in the paper about, my spouse died and the bank wouldn't pay. For me, I've got my personal story is my mom and dad, when they're in their 50s, built a year-round cottage down by our family cottage. And mom called me up all excited and she goes, oh, your father, the bank gave your father disability insurance on the mortgage. And I'm like, no, they didn't. And she's like, yeah, no, I've got it right here. And I go, okay. So she sent it over to me. I got a little letter signed from her saying the bank could talk to me directly. So I talked to this bank teller or associate or whatever they were, and I go, okay, question number like 6 of 50. They list about 20 conditions, and one of them was neurological disease. And I go, my father has Parkinson's, and she goes, yeah, I know, we talked about that, but I didn't think that was a neurological disease. So what would have happened in that situation is they would have paid the premium, and then at time of claim, 5, 10 years down the road, the bank would have said, "Oh no, you don't qualify for that coverage because you have Parkinson's." So that is just that false sense of coverage with sometimes with that mortgage insurance versus the term insurance. You're going to know up front, are you approved, are you declined, and you know that up front. To me, that's probably one of the most important differences, and it's just that peace of mind knowing, yes, I'm covered. Ooh, I hope I'm covered if something happens. So that to me is a huge one. Now, the other thing is what happens at death. So a lot of our clients, sure, some of them want to pay off the mortgage, but what are some of the other things you can do on a term insurance contract versus a mortgage insurance contract?
Well, the possibilities are endless when you have that term insurance, because your beneficiary, your family members, they're going to receive a tax-free check. So a lump sum tax-free check that they can use for whatever they want. So maybe maybe they want to pay off the mortgage. Not a problem. Pay off the mortgage. Maybe they actually want to sell the house. So they just pay those mortgage payments for a couple months until they're ready to sell, and then do it that way. Maybe they want to take a trip, anything. Like you think of it, they can use it. That that money's in their bank account for them to use as they need it. With the bank insurance, what's going to happen, or the mortgage insurance, what's going to happen is it's going to directly pay off that mortgage, right? So that could be, they're paying off the mortgage. That could be a couple $1,000s every month. But is that enough for a family, to keep going, just having that mortgage payment paid off? They're not going to have any extra.
Yeah, and I mean all kinds of options. I've got a daughter in university, and let's say my spouse gets a term insurance and can choose to do what she wants with it. Maybe some of it she'll pay for university. Maybe some of it she'll invest. Maybe some of it she'll put back into real estate. Again, just those options. Where you're making all the decisions instead of the bank just benefiting from the paying off the mortgage. So, all kinds of features. Any other features we missed, Christina, before we get into cost?
Yeah, so one other thing to mention is you did talk about disability insurance and how when you do sit down with the lender, they're going to offer life insurance, disability, and critical illness. We can do all of that on a personal policy as well. So term insurance, you can get we call them riders, but they're those extra benefits. So you can add a critical illness rider on there for critical illness. You can add a disability portion where they'll pay out the mortgage for you just the same, they'll pay out the mortgage for you just the same. And you mentioned your daughter as well. You can actually add child riders on there to protect your kids' insurability. So there's lots of extra benefits that you can add to a personal owned policy that you maybe don't have the options with on that mortgage insurance.
Wow. Okay. So we get a much better product, much more certainty. We've got way better features. We've got the higher death benefit. We've got the flexibility at death. Now, for all these additional benefits, how much more expensive is the term insurance versus the mortgage or bank-owned bank insurance?
A lot less. It's crazy, but when I sit down and I look at some of these ones when we're talking about it and we take a look at the difference, it can almost be half the cost. I'm not saying every time, but a lot of the time, you cut what you're paying in the bank in half, and that's what the new cost is going to be. So you get all of these additional benefits, and it is going to be about half the cost is what you're probably paying on your mortgage insurance right now.
So way better benefits, higher death benefit, more flexibility, and lower cost? Like,
Yeah.
why are people buying mortgage insurance versus term insurance? Is it just they get caught up, or they don't know, or they don't listen to podcasts like this? Like, why would someone do that? Is it just not being aware of the options?
I think that's definitely a part of it. They don't know that there's other options available as well. When I was sitting down today, they almost make it seem like it has to be a part of the contract that you need to take that insurance in order to complete the deal, which is just not the case, right? You can have your own insurance. You don't need to take the mortgage insurance through the lender. And then just knowing that these options out there exist, right? If you don't hear about it because the bank's not out there promoting it, you might not know.
Okay, well, we don't want to beat up banks too much. I already wrote a book called "Be the Bank," so you get a pretty good idea what I think of the typical bank. Now, there's good bankers and bad bankers, but okay, so term insurance far superior to the mortgage insurance. Now let's get into a little more term insurance details. So we talked about term 10, term 20. Let's go through kind of the differences of term 10 and term 20. Yes, we have term 25, term 30, term 5. There's all kinds of options. Term 10 and term 20 would be probably 95% plus of what people end up choosing, and they're the most competitive. Every insurance company offers term 10 and term 20. So from a price point, they tend to be very competitive in those. So if we look at a term 10, let's take a 30-year-old, $1 million coverage. That's going to be, 30-year-old's going to be about $40 a month for $1 million, give or take. Okay? And that term 10 means it's really good for 10 years, or term certain 10. So at the end of 10 years, it renews. It renews to this really crazy high number. In this example, the $40 goes to $475. Then in 10 years later, it goes to $1,200. Then to $3,600. And then when you turn 80, this term insurance goes to $9,000 a month. So between 80 and 85, you're going to spend about $500,000 in premium on this $1 million death benefit on top of what you've paid for the 50 years prior to that on the term insurance. So term insurance is really designed not to pay out long term. 1 or 2% of term insurance contracts actually pay out. Now, again, we need term insurance when you have liabilities and you have a family to protect it. But just keep in mind it's really long term, probably not going to pay out because most people will cancel at renewal. Term 20 is going to work the same way, except it's going to be a little higher starting out, but it's going to be locked in for 20 years. And that's a popular option for people, buying their first house with a 25-year mortgage. Term 20 would be, roughly 55, $60 a month, and then locked in for 20 years. And then you get those big price increases as well. So when we talk about term insurance, really the two key features are renewable and convertible, RNC. So renewable, let's talk about renewable. We talked about renewing at those higher rates. Christina, walk me through a renewal and why somebody would renew their term insurance.
So like you said, with the term 10, it means that your price is locked in for 10 years, right? So at the end of the 10 years, you got to come to a decision. So there are a couple options for you. So you can take that renewable amount. So I know you're saying it jumps to $400, but when you think of it, if you need that insurance, it's going to make sense to take that $400. Why would you need to keep that insurance? Well, as we talked about earlier, you need to be insurable when you're getting one of these personal policies, which means you have to do a new application. If you wanted a new coverage, you'd have to do a new application. They do that underwriting. They'd approve you at that point in time. If over that 10-year period you have developed a medical condition or a medical problem that would lead to a decline, then you're not going to be able to get that new coverage, which means it might make sense to take that renewal, right? Because you need to keep that coverage. If you're not in good health, you're going to want to keep that coverage. So it's just an option that they give you, and they give you a couple options, like you said. So you can cancel at the end of a term. Obviously, you can cancel at any point in time, but you can take the renewal option. You can apply for a new policy if you need a longer term, if you still need that mortgage protection, or you have that conversion option that you mentioned. So Darren, if you want to talk a little bit more about that.
Yeah, I do. So just before we jump into the conversion, so on that renewal, basically the people taking the renewals are the people that can't qualify for a new plan. So instead of jumping to $400 a month, if you're still insurable after 10 years, you might be, $60 a month for a new policy, just 10 years older from your initial policy. So 40 to 60 instead of 40 to 400. But then you're really rolling the dice to say, I pretty sure I'm going to be insurable in 10 years. Some people take that. Other people just take the 20-year, depending upon how old you are. Now, if you're 50 and you only have a mortgage for a shorter period of time, then maybe the term 10. But yeah, Christina, the conversion option, and again, like underwritten at time of at issue is huge, and then this is the conversion option that I think is equally as important. And this is how it all ties into this infinite banking strategy that we're experts at. So how does this term insurance apply to infinite banking? Well, the conversion option on term insurance states that you can convert your insurance that you have to a permanent insurance policy with no medical evidence. So no questions asked, you can convert it. So you could convert, if you had $1 million of term insurance and all of a sudden, few years, 5, 10 years down the road, you wanted to do a whole life, well, you can convert to whatever that insurance company has, universal life or whole life. But again, we talk about there's only really 4 insurance companies that offer this participating whole life that works with the infinite banking strategy. So unless you're with one of these 4 companies for the term insurance, you can't convert to participating whole life or an infinite banking policy or proper infinite banking policy. So when you're selecting your term, it is vitally important that you're dealing with someone that knows which companies offer that participating whole life to give you that conversion option. So walk me through some scenarios where you'd convert your insurance, Christina, to a permanent participating whole life contract. Why would you convert and when would you convert?
Well, why would you convert? So you can start your infinite banking policy, obviously. That's a no-brainer. But for the term insurance, we purchase term insurance for a certain need, which is your mortgage, a short, a need that's not going to be around forever. So once that is paid up, you may no longer need the term insurance, but you need something more permanent. This is when a lot of people will look at getting their infinite banking policy put in place. Another reason, or another way that we see it happen is we have clients that have their first policy, or maybe they're not ready for their first policy, and they are going to purchase a term insurance policy just to strictly lock in their insurability. So we talked about not being able to get that policy if you are no longer insurable at that time, if your health has changed. So what people will do is they'll purchase a term insurance policy, you know, for 500,000 or a million, whichever they think they're going to need for their infinite banking policy. They're going to pay those smaller rates now to lock in their insurability. So when they're ready for that second policy, they're ready for their first policy. It's a signature on a page, and they're ready to go. There's no underwriting questions.
So no medical questions at all when you convert. And just to follow up on that, one of the great things about the conversion too is you don't have to convert the entire amount. So let's say you have $1 million of term insurance, and then like 2 years in, you go, okay, well now I'm ready for this infinite banking strategy, and you want to do a $20,000 or $25,000 a year contribution. Well, maybe you only need $300,000 or $400,000 of whole life to be able to put in or save $20,000 to $25,000 a year. Well, we can go to the insurance company and say, okay, we've got $1 million of term. Let's take $300,000 or $400,000, convert that to the participating whole life, and the difference, you know, the $600,000 or $700,000 of term, we'll just keep that in place because if we have a need for it, we'll maintain that. We'll start the infinite banking policy, convert a portion of it. 2 years later, we'll start another policy, convert another portion, and then another one. So you're really, like you said, building in your insurability that you're never going to have to go through that again. And then the last point on that, I'd say, often when people buy a policy, when they start an infinite banking policy, you know, their expectation is they will have additional policies, and we see it every day in our office, people buying second, third, fourth, fifth policies. So if you're qualifying medically anyway, they're going to be asking the underwriting questions for an infinite banking policy. And then if you anticipate there's either going to be a need for additional ones or you have a need for insurance, well, you've already answered those medical questions. So it's a perfect time to say, okay, I'm going to take my infinite banking policy, but why don't I also take a term policy that's going to give me the option of converting down the road with no medical evidence and give me that inexpensive death benefit. Now, it's not a long-term solution because term insurance is designed to lapse or designed to make you cancel, but it really just emphasizes the key of it's not just a quick decision you make when you get a mortgage and you buy a house and you're all excited. You got to step back and say, okay, I got to think long-term. I got to think, what are my finances going to be in 2 years, 5 years, 10 years, 20 years? And at the end of the day, even if you never convert your term policy to a participating whole life policy, the term cost with one of the companies that offer participating whole life and the other term carriers is basically the same. The 4 carriers we use are usually at the top of the list. We've got software we can run for clients and say, if you want term insurance, here's the least expensive term insurance, every insurance company in Canada. And the big 4 we use, they're always right around the top. And at the end of the day, if it's 50 cents more to build in all this flexibility and options down the road for 50 cents a month, let's take advantage of options down the road. Anything else before we wrap up, Christina?
No, I think we've covered it for now. We've gone through, you know, the main points, and I think we've made it pretty clear that you're probably better off, or you are always better off getting the personal insurance versus getting it through your lender. So just make sure that you go out and you check out those options the next time you're signing those documents, like I did this morning.
Fantastic. Okay, Christina, thanks for your time today. So that kind of wraps up the mortgage insurance versus term insurance and how it all kind of applies to infinite banking strategy. Thanks for watching and thanks for listening. Thanks for tuning into this episode. Don't forget to like, subscribe, and hit that bell button so you always know when new content is coming out. For more helpful tips and tricks, visit our Instagram, Facebook, or TikTok pages at Control and Compound. If you want to reach out to us directly or work with us, visit our website at controlandcompound.com. The links are in the show notes below. See you next episode.